tax season brings out the worst in people's math skills and the most creative interpretations of tax law ever attempted. While most people just pay their taxes and move on with life, these ambitious individuals decided they were smarter than the entire IRS and could outsmart a system that's been collecting money from reluctant citizens for over a century. Spoiler alert, they weren't. And the IRS has seen every trick in the book, plus several that aren't in any book. 1. I'm claiming my dog as a dependent because he lives in my house and I support him financially, announced pet owner Patricia to her horrified tax preparer, producing vet bills and food receipts as proof of her golden retriever's qualification for tax dependency status. Her dependent claim included arguments that pets provided emotional support equivalent to human family members, and that veterinary expenses were basically medical costs for household dependents. Patricia's tax strategy fell apart when the IRS pointed out that dependents required social security numbers, which dogs don't qualify for regardless of their emotional contributions to household stability. 2. The Church of Tax Exemption was founded in Marcus's garage, where he declared himself a religious leader and his entire income as tax-exempt religious donations to his personally established faith. His spiritual organization featured a congregation of one, religious services held in his living room, and sacred texts he'd written himself explaining why his salary counted as religious tithes. Marcus's divine tax strategy lasted until the IRS discovered that legitimate religious organizations required more than creative paperwork, and that self-proclaimed prophets still owed taxes on their earthly income. 3. I'm moving to international waters, declared maritime tax avoider Sarah, who purchased a small boat and claimed residency in areas beyond government taxation authority. Her oceanic lifestyle included anchoring 3 miles offshore and arguing that her floating home placed her outside IRS jurisdiction while she commuted to her land-based job daily. Sarah's nautical tax strategy failed when the Coast Guard explained maritime law and the IRS clarified that U.S. citizens owed taxes regardless of where they parked their boats. 4. Professional barter economy participant Dave decided money was a government conspiracy and switched to trading goods and services to avoid cash transactions that could be taxed by federal authorities. His cashless lifestyle included elaborate trading networks where he exchanged carpentry work for groceries, car repairs for dental services, and plumbing skills for haircuts. Dave's barter empire collapsed when the IRS explained that traded services still constituted taxable income, and that creative payment methods didn't eliminate tax obligations. 5. The home office deduction reached epic proportions when entrepreneur Lisa claimed her entire house as business space, including bedrooms, bathrooms, and the kitchen, as essential components of her home-based consulting empire. Her business facility included claims that every room served vital business functions, and that her entire mortgage, utilities, and household expenses qualified as legitimate business deductions. Lisa's comprehensive home office strategy failed during an audit when she couldn't explain how her bedroom served business purposes or why her business required residential bathroom facilities. 6. Rich people don't pay taxes, so I shouldn't either. Served as class warfare justification for wannabe wealthy person Tom, who stopped filing tax returns entirely based on internet articles about wealthy tax avoidance strategies he didn't understand. His rich person emulation included beliefs that tax payments were optional for people who consider themselves financially sophisticated, and that the IRS only pursued middle-class taxpayers. Tom's wealth aspiration strategy ended with penalties, interest charges, and collection notices that proved the IRS collected taxes from broke people who thought they were rich. 7. The charity donation scheme involved Kenneth starting a nonprofit organization that existed solely to receive his own donations, creating a circular charity system where he donated money to himself and claimed tax deductions for his generous contributions. His charitable empire included elaborate paperwork, documenting donations to causes that benefited only him, and tax deductions that exceeded his actual charitable giving by creative accounting margins. Kenneth's self-charity strategy failed when the IRS investigated his nonprofit and discovered that charitable organizations couldn't exist primarily to benefit their founders. 8. I identify as a corporation, announced business entity Rachel, who filed paperwork attempting to legally transform herself into a corporate structure eligible for business tax rates rather than individual tax obligations. Her corporate identity strategy included arguments about business tax advantages and claims that personal incorporation would allow her to expense her entire lifestyle as legitimate business costs. Rachel's corporate transformation failed when the IRS explained that individuals couldn't become corporations through creative paperwork, and that personal expenses remained personal regardless of business filing status. 9. Time travel tax strategy emerged when creative accountant Mike claimed his income occurred in previous tax years when rates were lower, arguing that his paycheck dates were arbitrary and that he could assign earnings to more favorable tax periods through retroactive income allocation. His temporal income redistribution included elaborate calculations showing how his current salary would have been taxed differently in previous decades, and arguments that tax year assignments were flexible based on taxpayer preference. Mike's time-based tax strategy failed when the IRS clarified that income taxation followed calendar years rather than taxpayer time travel fantasies. 10. The foreign citizenship route involved patriotic American Jennifer renouncing her U.S. citizenship on paper while continuing to live, work, and vote in America, claiming that her new citizenship in countries she'd never visited exempted her from American tax obligations. Her international tax strategy included purchasing citizenship documents online and arguing that her theoretical foreign nationality superseded her practical American residency for tax purposes. Jennifer's citizenship shopping strategy failed when the IRS explained that tax obligations followed residency and income sources rather than purchased paperwork citizenship claims. 11. Taxes are unconstitutional, served as legal defense for constitutional scholar Robert, whose tax protest movement included extensive research into founding fathers' intentions and arguments that income taxation violated constitutional principles that he'd interpreted through internet legal research. His constitutional tax resistance included filing detailed legal briefs explaining why the 16th Amendment was invalid and demanding that courts recognize his constitutional right to keep his entire paycheck. Robert's constitutional strategy failed in tax court, where judges explained that constitutional amendments were legally binding, regardless of individual citizen interpretations. 12. The business expense maximization system transformed every aspect of personal life into tax-deductible business costs when consultant Amanda claimed her clothing, meals, entertainment, and transportation as necessary business expenses for her one-client consulting business. Her business lifestyle included arguments that professional appearance required designer clothing deductions, and that business networking necessitated expensive restaurant meals with friends. Amanda's comprehensive business expense strategy failed during an audit, when she couldn't demonstrate how personal expenses served legitimate business purposes. 13. I'm paying in Bitcoin, announced cryptocurrency enthusiast Gary, who believed that digital currency transactions were invisible to government taxation, and that Bitcoin payments exempted him from traditional tax reporting requirements. His digital currency strategy included converting all income to cryptocurrency and arguing that virtual money existed outside government regulatory authority. Gary's crypto tax strategy failed when the IRS explained that cryptocurrency transactions were fully taxable and that digital money was still money for tax purposes. 14. Retirement fund manipulation reached new levels when early retiree Helen attempted to withdraw her entire 401k penalty-free by claiming financial hardship, medical emergencies, and educational expenses simultaneously to avoid early withdrawal penalties and taxes. Her retirement access strategy included multiple hardship applications and creative interpretations of qualifying circumstances that would allow tax-free retirement fund access before retirement age. Helen's early retirement strategy failed when the IRS reviewed her hardship claims and discovered that wanting money didn't constitute legitimate financial emergency. 15. The gift tax loophole involved generous parent Paul giving his adult children massive gifts that were actually salary payments for imaginary work at his business. treating wage payments as tax-free family gifts that avoided payroll taxes and income reporting requirements. His family employment strategy included elaborate gift documentation and claims that family financial support constituted charitable giving rather than compensation for services. Paul's gift strategy failed when the IRS investigated his business and discovered that his children's gifts corresponded exactly to work schedules and that family gifts couldn't replace legitimate payroll reporting. 16. I'm a sovereign citizen, declared independent nation founder Carol, who established her property as an autonomous zone, exempt from federal taxation and government regulation, through creative legal documents she drafted herself. Her sovereignty strategy included flags, official seals, and declaration of independence from tax obligations based on constitutional interpretations she'd learned from internet forums. Carol's sovereign nation strategy failed when federal agents explained that personal property couldn't secede from tax obligations, and that creative legal documents didn't create actual legal exemptions. 17. Medical expense maximization transformed routine healthcare into comprehensive tax deduction strategies when hypochondriac Steve claimed every possible health-related expense as medical deductions, including gym memberships, organic food, massage therapy, and vacation travel for stress relief. His health investment strategy included arguments that preventive healthcare justified unlimited medical expense deductions, and that wellness activities constituted legitimate medical treatments. Steve's medical expense strategy failed during an audit when he couldn't provide medical necessity documentation for his spa vacations and fitness club memberships. 18. The loss harvesting scheme involved day trader Lisa deliberately losing money on investments to create tax deductions that would offset her employment income, treating investment losses as tax planning tools rather than actual financial losses. Her strategic losing strategy included elaborate trading plans designed to maximize deductible losses while minimizing actual financial impact through complex financial instruments she didn't understand. Lisa's loss strategy failed when her investment losses exceeded her tax savings, and she discovered that losing money to save taxes still resulted in net financial loss. 19. Taxes are theft served as philosophical justification for libertarian tax resistor Kevin, whose principled non-payment strategy included detailed manifestos about government overreach and arguments that taxation violated natural rights and property ownership principles. His political tax resistance included organizing tax protest groups and encouraging others to join his principled stand against government fund collection through taxation. Kevin's philosophical strategy failed when the IRS explained that political disagreement with tax policy didn't exempt citizens from tax payment obligations. 20. The educational expense deduction expanded beyond recognition when lifelong learner Michelle claimed every book, magazine, documentary, and online course as educational business expenses necessary for her professional development and income generation. Her learning investment strategy included arguments that all knowledge acquisition constituted job-related education, and that intellectual development qualified as legitimate business expense regardless of actual professional relevance. Michelle's educational strategy failed when the IRS reviewed her deductions and discovered that her professional development included cooking classes, art history courses, and foreign language instruction unrelated to her accounting career. 21. Rental property creativity peaked when homeowner Daniel attempted to rent rooms in his house to himself, creating rental income and rental expenses that would offset each other while generating business deductions for his primary residence. His self-rental strategy included lease agreements with himself and arguments that internal rent payments created legitimate business transactions that qualified for rental property tax benefits. Daniel's self-landlord strategy failed when the IRS explained that renting property to yourself didn't create actual rental income or legitimate business expenses. 22. The farming tax shelter emerged when suburban lawyer Nancy purchased 2 chickens and claimed agricultural tax exemptions for her backyard poultry operation, treating her hobby as commercial farming eligible for agricultural tax benefits and rural business deductions. Her farming empire included detailed business plans for her 2-chicken operation and arguments that small-scale agriculture qualified for the same tax benefits as large commercial farming operations. Nancy's agricultural strategy failed when the IRS investigated her farm and discovered that 2 backyard chickens didn't constitute legitimate commercial agriculture. 23. "I'm writing a book about my life," announced author Wannabe Frank, who claimed every life experience as research expense for his upcoming autobiography, treating personal activities as business costs for his theoretical writing career. His literary business strategy included arguments that travel, entertainment, and daily expenses constituted research for his book project, and that aspiring authors could deduct living expenses as business costs. Frank's writing strategy failed when the IRS asked to see his book progress and discovered that his literary career consisted entirely of tax deduction claims without any actual writing. 24. The vehicle depreciation scheme involved entrepreneur Victor purchasing expensive cars as business equipment and claiming massive depreciation deductions for vehicles he used primarily for personal transportation, treating luxury car ownership as business investment rather than personal expense. His automotive business strategy included elaborate justifications for business vehicle necessity and calculations showing how expensive cars generated larger tax deductions than modest business transportation. Victor's vehicle strategy failed during an audit when he couldn't demonstrate legitimate business use for his luxury car collection. 25. "My gambling losses offset my winnings," explained casino regular Brenda, whose gaming investment strategy involved claiming gambling losses as business expenses while reporting minimal gambling winnings, treating recreational gambling as professional business activity eligible for loss deductions. Her professional gambling strategy included detailed records of casino visits and arguments that gambling constituted business activity rather than entertainment expense. Brenda's gambling strategy failed when the IRS reviewed her records and discovered that her gambling losses exceeded her reported income by impossible margins. 26. The artist tax shelter involved creative professional Ellen claiming her entire lifestyle as artistic business expenses, treating personal activities as art research and daily experiences as creative inspiration that qualified for business deduction. Her artistic business strategy included arguments that artists needed diverse life experiences for creative inspiration, and that all personal expenses contributed to artistic development. Ellen's creative strategy failed when the IRS asked to see her art sales and discovered that her artistic career generated no income despite claiming thousands in business expenses. 27. "I'm claiming depreciation on my body," announced fitness enthusiast Mark, whose physical asset strategy involved treating his body as business equipment that depreciated over time through aging and required maintenance expenses through health and fitness investments. His human capital strategy included arguments that physical appearance was essential for his career and that body maintenance constituted legitimate business expense. Mark's physical depreciation strategy failed when the IRS explained that human bodies couldn't be depreciated like business equipment, regardless of career physical requirements. 28. The travel expense maximization involved vacation photographer Sam, claiming every trip is business travel for his photography business, treating personal vacations as business expenses through creative documentation of minimal business activity during family trips. His travel business strategy included arguments that photography opportunities existed everywhere and that all travel contributed to his artistic development and business portfolio expansion. Sam's travel strategy failed during an audit when he couldn't demonstrate genuine business purpose for family vacation travel that included minimal actual photography work. 29. "My house is a historical landmark," declared preservation enthusiast Diane, who attempted to claim historical preservation tax credits for routine home maintenance by arguing that her 1970s house qualified as historically significant architecture worthy of preservation tax benefits. Her historical strategy included elaborate documentation of her home's historical importance and arguments that maintaining historical properties deserved tax incentives regardless of actual historical significance. Diane's preservation strategy failed when historians explained that 1970s suburban houses didn't qualify as historically significant architecture. 30. The consultation business emerged when advice giver Roger started claiming payment for giving friends and family members unsolicited advice, treating casual conversations as consulting services that generated business income and business expense deductions for his lifestyle costs. His consulting empire included elaborate invoicing systems for advice nobody requested and arguments that his wisdom constituted valuable consulting services worthy of business tax treatment. Roger's consulting strategy failed when the IRS investigated his business and discovered that his consulting clients were family members who never paid for his unrequested advice. 31. I'm investing in myself. Served as education justification for personal development enthusiast Patricia, whose self-investment strategy involved claiming personal improvement courses, life coaching sessions, and motivational seminars as business education expenses for her career development. Her self-improvement business strategy included arguments that personal development directly enhanced professional capabilities and that investing in human capital qualified for educational business deductions. Patricia's self-investment strategy failed when the IRS reviewed her education expenses and discovered that personal development courses didn't qualify as legitimate business education. 32. The energy credit maximization involved environmentalist George claiming every possible green energy tax credit through creative interpretations of qualifying improvements, including solar garden lights, energy-efficient light bulbs, and programmable thermostats as major renewable energy installations. His environmental strategy included arguments that small energy improvements deserved the same tax credits as major installations, and that environmental consciousness should be rewarded through comprehensive tax benefits. George's energy strategy failed when inspectors reviewed his improvements and discovered that his renewable energy installations consisted of decorative solar lighting. 33. My dog is a business partner, announced pet business owner Helen, whose canine partnership strategy involved claiming her dog as business co-owner eligible for business expense sharing and partnership tax benefits through creative legal documents establishing her pet as a legitimate business entity. Her animal business strategy included arguments that trained dogs provided essential business services and that animal partners deserved business recognition and tax benefits. Helen's pet partnership strategy failed when the IRS explained that animals couldn't be business partners regardless of their training or business contributions. 34. The home security deduction emerged when safety-conscious Bill claimed comprehensive home security systems as business expenses for his home-based business, treating personal security measures as business protection costs eligible for business expense deduction. His security business strategy included arguments that home businesses required enhanced security and that protecting business equipment justified personal security system deductions. Bill's security strategy failed during an audit when he couldn't demonstrate how personal home security served legitimate business purposes beyond general property protection. 35. I'm conducting social experiments, announced research participant Lisa, whose experimental strategy involved claiming her lifestyle as legitimate research activity that generated business expenses for her undefined research projects and social science investigations. Her research business strategy included arguments that social observation constituted legitimate business activity and that experimental living generated valuable research data worthy of business expense deductions. Lisa's research strategy failed when the IRS asked to see her research results and discovered that her social experiments existed only for tax deduction purposes. 36. The entertainment business involved party host Mike claiming his social gatherings as business networking events that generated business expenses for food, beverages, and entertainment costs through creative documentation of business purposes for personal parties. His networking business strategy included arguments that social connections provided business value and that entertainment expenses contributed to business relationship development. Mike's entertainment strategy failed during an audit when he couldn't identify actual business results from his networking parties or demonstrate legitimate business purposes for his social entertaining. 37. My commute is business travel, declared creative commuter Nancy, whose transportation strategy involved claiming daily driving to work as business travel expense by arguing that traveling between business locations qualified for business mileage deductions, regardless of employment status. Her commuting business strategy included elaborate mileage logs and arguments that all work-related transportation deserved business expense treatment. Nancy's commuting strategy failed when the IRS explained that regular commuting to employment locations didn't qualify as business travel regardless of creative documentation. 38. The clothing business emerged when fashion enthusiast Robert claimed his entire wardrobe as business expenses for his professional image consulting business, treating personal clothing purchases as business inventory and professional development costs. His fashion business strategy included arguments that professional appearance required extensive wardrobe investment and that clothing purchases constituted business equipment necessary for image consulting services. Robert's clothing strategy failed when the IRS investigated his business and discovered that his image consulting clients existed only for tax deduction purposes. 39. "I'm beta testing life," explained experimental living participant Karen, whose testing strategy involved claiming her lifestyle choices as business research for undefined product development projects that required comprehensive testing of consumer products and services. Her beta testing business strategy included arguments that product testing constituted legitimate business activity and that testing expenses qualified for business deductions regardless of actual business outcomes. Karen's testing strategy failed when the IRS asked to see her testing results and discovered that her beta testing business existed only to justify personal expense deductions. 40. The hobby business transformation involved craft enthusiast Steve converting his recreational activities into business ventures by claiming hobby expenses as business costs for enterprises that generated minimal income but maximum tax deductions. His hobby business strategy included arguments that creative activities constituted legitimate business ventures and that artistic pursuits deserved business tax treatment regardless of actual profitability. Steve's hobby strategy failed during an audit when he couldn't demonstrate genuine business purpose for activities that were obviously recreational rather than commercial. 41. "My house is a retail store," announced inventory manager Tom, whose retail strategy involved claiming his home as commercial retail space by storing minimal business inventory in his residence and arguing that residential space qualified for commercial property tax benefits. His retail business strategy included elaborate documentation of his home retail operations and arguments that home-based retail deserved the same tax benefits as commercial retail space. Tom's retail strategy failed when inspectors reviewed his operations and discovered that his retail business consisted of occasional online sales that didn't justify commercial property claims. 42. The fitness business involved health enthusiast Jennifer claiming her personal fitness routine as business activity for her theoretical fitness consulting business, treating gym memberships, personal training, and fitness equipment as business expenses for her undefined fitness services. Her fitness business strategy included arguments that fitness professionals needed personal fitness maintenance and that health investments constituted business development costs. Jennifer's fitness strategy failed when the IRS investigated her business and discovered that her fitness consulting services existed only for tax deduction purposes. 43. "I'm providing family financial services," explained banking entrepreneur William, whose family finance strategy involved claiming family money management as business activity that generated business expenses for his household financial administration services to family members. His financial services business strategy included elaborate documentation of family financial management and arguments that household budgeting constituted professional financial services worthy of business expense deductions. William's family finance strategy failed when the IRS explained that managing personal family finances didn't constitute legitimate business activity. 44. The technology business emerged when gadget lover Carol, claiming every electronic device purchase as business equipment for her undefined technology consulting business, treating personal technology purchases as business investment in consulting service capabilities. Her technology business strategy included arguments that technology consultants needed comprehensive equipment testing and that electronic purchases constituted business development investments. Carol's technology strategy failed during an audit when she couldn't identify actual consulting clients or demonstrate business use for her personal technology collection. 45, and finally, there's Martin, who attempted the most comprehensive tax avoidance scheme in amateur tax history by simultaneously claiming to be a religious leader, sovereign citizen, foreign resident, business corporation, and time traveler, whose income occurred in tax-free dimensions that existed outside government jurisdiction. His multi-dimensional tax strategy involved combining every possible tax avoidance theory into one comprehensive exemption claim that included spiritual income protection, sovereign immunity, international residence, corporate tax rates, and temporal income displacement across multiple tax years and dimensional realities. Martin's universal tax exemption strategy included detailed documentation supporting each exemption theory and arguments that combining multiple tax avoidance strategies created comprehensive tax immunity that superseded all government taxation authority. His dimensional tax resistance included claims about alternative reality income sources and arguments that interdimensional travel exempted him from single reality tax obligations. Martin's comprehensive strategy failed when the IRS explained that creative combinations of invalid tax theories didn't create valid tax exemptions, and that citizens couldn't exempt themselves from tax obligations through elaborate fantasy documentation. His multi-dimensional tax case became training material for IRS agents who needed examples of comprehensive tax delusion and creative accounting fiction. Martin's tax avoidance empire collapsed when federal investigators discovered that his interdimensional income sources were actually regular employment payments, and that his multiple exemption claims contradicted each other in ways that made his entire strategy legally and logically impossible. Here's the ultimate truth about tax avoidance. The IRS has been collecting taxes since 1913 and has encountered every creative exemption theory that human imagination can produce. These people discovered that tax law is written by lawyers, enforced by accountants, and interpreted by judges who are significantly smarter than amateur tax protesters with internet access. The most expensive tax advice is the kind you give yourself after reading conspiracy theories online. Want to avoid paying too much in taxes? Hire a legitimate accountant. Want to avoid paying any taxes? Enjoy explaining your creative theories to federal judges who have heard them all before. Subscribe if you prefer learning about tax law from qualified professionals rather than federal prosecutors.